Ever considered how real estate moguls make their magic happen? Is it all just big money, or are there smart financing techniques at play? Welcome aboard on this enlightening journey where we uncover the secrets behind successful real estate investments. It's not always about having deep pockets. In fact, most of the time it's about smart financial strategies, understanding the market, and making informed decisions. In the intriguing world of real estate financing, it's crucial to know your options and how to leverage them. From traditional bank loans to more creative financing methods, the choices are aplenty, and one such option is a strategy that not everyone talks about, but it's a game changer if you know how to use it correctly. This technique is a combination of a new first mortgage and a seller's second mortgage. It's a strategy that could potentially revolutionize your real estate investment game. Fascinated? Stick around as we dive deeper. At the heart of this technique are two elements, a new first mortgage and a seller's second mortgage. But what exactly are these? Well, let's break it down. A new first mortgage is the primary loan that covers the initial cost of a property. It's the largest loan you'll likely take out, and it's the one that comes with the property as collateral. Imagine you're buying a property worth $100,000. You approach a bank or a financial institution and they agree to loan you $80,000. This loan is your new first mortgage. On the other hand, a seller's second mortgage, also known as seller financing, is where the seller of the property agrees to lend you part of the purchase price, separate from the first mortgage. It's a flexible, creative financing option that can make a significant difference to your real estate deal. Back to our example, the remaining $20,000 could be financed by the seller, making it the seller's second mortgage. The beauty of this technique is that it allows you to purchase properties with less out-of-pocket capital, increasing your purchasing power. It's a win-win situation for both the buyer and the seller. As a buyer, you get to secure a property with less initial capital. As a seller, it makes the property more attractive to potential buyers, and could potentially lead to a faster sale. One thing to note, though, is that this technique requires a cooperative seller and a lender who is open to this kind of setup. It's not the traditional way of doing things, but when done right, it can open up a world of possibilities. Additionally, this technique is more than just about buying properties. It's about leveraging your capital efficiently. It's about making your money work harder for you, allowing you to grow your real estate portfolio quicker and smarter. So we've got our two elements. Now, how do they work together in a real estate deal? Let's unravel this mystery. Imagine you're eyeing a property. Your first step would be to secure a new first mortgage from a bank or financial institution. This usually covers the majority of the property's price, say 70 to 80%. It's your primary loan and takes precedence over any other liens or claims on the property. Now here's where the seller's second mortgage comes into play. This is a loan that the seller of the property provides to you, the buyer. The seller essentially becomes a lender, holding a second mortgage on the property. This mortgage typically covers the remaining balance of the property's price, after the first mortgage. The seller's second mortgage is subordinate to the first one, meaning if matters come to foreclosure, the first mortgage gets paid off before the second. So, why use this technique? 1. It can help you purchase a property with less upfront cash. 2. It can make a property more attractive to potential sellers as it provides them with an additional income stream. And 3. It can provide a safety net if you encounter financial difficulties. But remember, like all financial strategies, it carries its own risks. Always do your due diligence and seek professional advice before diving in. And there you have it. A step-by-step guide to using a new first mortgage and a seller's second mortgage in your real estate deals. So, what have we learned about this financing technique? It's clear that the new first mortgage and seller's second mortgage technique offers a unique approach to real estate financing. By combining these two methods, investors can potentially fund their property purchases more effectively. It's a strategy that requires understanding and finesse, but when executed correctly, it can yield substantial benefits. Next time you're considering a real estate investment, remember this technique. It could be the key to your next successful deal. Until then, keep learning, keep investing, and keep growing. Like and subscribe to this channel if you like these educational videos. Thanks.